Can I actually figure out what the price-to-earnings ratio means for my money in under 10 minutes? The price-to-earnings ratio, or PE ratio, is one of those financial metrics that gets thrown around a lot, but do we really understand what it means? I'm here to demystify it for you, so you can have a better grasp of your financial understanding. You might have seen headlines saying a certain stock has a high or low PE ratio, but what does that really tell us? A lot of people get confused by this metric, and it's easy to see why. It's just a number, after all. But understanding the PE ratio is crucial for making informed investment decisions, rather than just blindly following headlines. If you don't grasp the PE ratio, you might end up making decisions based on incomplete information. This can lead to missed opportunities or, worse, financial losses. The PE ratio is actually pretty simple. It's calculated by dividing the stock's current price by its earnings per share, or EPS. Let's say a company's stock price is $100, and its EPS is $5. That would give it a PE ratio of 20. But what does that number mean? Well, it tells you how much investors are willing to pay for a dollar of the company's earnings. Different industries have different normal PE ranges, so it's not always a one-size-fits-all situation. For example, tech companies often have higher PE ratios than utility companies. This is because investors expect tech companies to grow faster, so they're willing to pay more for their earnings. On the other hand, utility companies are often seen as more stable, but with lower growth potential, so their PE ratios tend to be lower. A high PE ratio can be interpreted as a sign that investors expect the company to grow rapidly in the future. But it can also mean that the stock is overvalued. A low PE ratio, on the other hand, might indicate that a stock is undervalued, but it could also mean that investors expect the company's earnings to decline. Let's consider a hypothetical scenario. Company A has a PE ratio of 30, while Company B has a PE ratio of 15. If both companies have similar growth prospects, Company B might be seen as a better value. However, if Company A is expected to grow much faster than Company B, its higher PE ratio might be justified. As you can see, interpreting PE ratios requires some nuance. It's not always a clear-cut decision. But by understanding what the PE ratio represents, you can make more informed investment decisions. In summary, the PE ratio helps you understand if a stock is cheap or expensive relative to its earnings. It's a useful tool, but it's not the only metric you should consider. You should always use it in conjunction with other metrics to get a complete picture of a company's financial health. If you've got other financial terms you're curious about, share them in the comments below. Don't forget to like this video and subscribe for more personal finance insights.